Hello guys, this is Vineet from Edge-Forex. Today is the 18th of August 2024 and I want to today just have a little chat about CPI, inflation, deflation, how does it all kind of come together with the Fed's interest rate policy. So first we need to understand what CPI is. It is Consumer Price Index and it is a basket of a lot of things that we need and use on a day-to-day basis, like food, the price of gasoline, rent, or medical services that we use on a day-to-day basis. So that is measured on a monthly basis. So if that basket of goods and services cost $105 this month compared to $100 last month, there is a 5% increase. That means there is an inflation of 5% month over month. Inversely, if the same basket of goods and services cost $95 this month compared to $100 last month, that is called a deflation. So there's a deflation of 5%. So what happens when there is inflation in the marketplace above and beyond what is normal? And we'll talk about what normal is. So people think that prices are going higher faster than they would like to. And what they do is to start buying things and hoarding things. So what that does is creates a lot of artificial demand from future brought into the present. So what happens, the economy starts to overheat and there are not enough goods and services because people are hoarding things, people are buying things prematurely. So that is of course not good for the marketplace because now we are producing things and we are using things that we don't need to. So there is undue pressure on the commodity prices and on the raw material prices that again increases the prices of the goods and services month on month basis. That can get out of hand and the inflation rates can climb really high really fast and lead to an extreme condition called hyperinflation, which is really bad for the economies. The prime example today is Zimbabwe, where there is so high inflation that every few years they have to introduce a new currency. So hyperinflation, what it does is it kills the economies, it kills the currency because your money is worth less. And you start to lose confidence in the money or in the currency that you're holding. And central banks don't want that situation. So now let's look at deflation. Why is deflation bad? Because your money is now gaining value or gaining strength month over month. So what you do is you, instead of buying goods and services, you want to hoard money and you don't want to buy anything because you think, hey, next month I'm going to be able to buy much more with my money. So what that does, it slows the economy down to a point where factories and businesses cannot sustain themselves because there is not enough sales, there is not enough business activity to keep them going, to pay wages. So that results in job cuts and business closures. So any extreme, either too much inflation or too much deflation, is bad. So now how does central bank or how do governments, they stop or control these two extremes? They do that by either increasing or decreasing interest rates. So now if there is too much inflation, that's when people don't have enough confidence in keeping their money. What government does is they increase interest rates. So people are encouraged to save money because now they know that, hey, if they put the money in their bank, it's going to increase in value because they're going to get more units of the money in the way of interest. So that encourages them to save money and not to go spend it in a hurry and bring the future demand into present, and that way economy can grow at a sustainable pace. It also has another side effect. It makes that currency that much more attractive for international investors. So now, as I've said before so many times, money flows where it's treated the best. So now increasing interest rates attracts foreign investments. People from outside of the country want to come in and invest in the bonds for that particular country, and what that does is increases the value of that particular currency. So if the interest rates are going high, it attracts investments, it attracts savings, increasing the value of the currency. Now the opposite happens in the case of deflation. If people are hoarding money and they're not spending money, and businesses and the economy is slowing down, businesses are closing, a lot of jobs that are being lost because people are just holding on to the money because maybe they're getting too much return on the money, their money is getting stronger on a month-to-month basis. In that particular case, what central banks do is they decrease or cut interest rates, and that encourages spending. That encourages people going out and start buying things, start spending money, and create the demand for those goods and services, which leads to job creation, new businesses opening, and a vibrant economy. So it's a cycle that kind of repeats itself every few years. So now let's talk about what's happening now. So we know that the economy is slowing down. We know that the raw material or the commodity prices are crashing like anything. We know the productivity is slowing down. We know that unemployment is, even though, yes, it's positive, we are creating jobs worldwide, but the rate of the job creation has fallen dramatically. So not nearly enough jobs are being created to satisfy the supply of the labor in the marketplace. So now to mitigate all of that, Fed has said, okay, they are going to drop the interest rates starting next month, which is their September meeting. Now the question is, how much are they going to drop the rates by? So 50% are saying 25 basis points or 0.25%. The other 50% are saying it's going to be 0.5% or 50 basis points. So bigger the rate cut, worse it is for the dollar. So if it's a 25 basis point, dollar may or may not drop. But if it's a 50 basis point, the dollar will drop in all likelihood, because it's now becoming less and less attractive for the investors to park their money in the dollars, because now bonds are yielding less. On the other hand, stocks are getting more attractive. Precious metals are getting a bid. So like I've said so many times before, money is going to go where it's treated best. And right now, US dollar, especially in the environment where the interest rates are being dropped, is not being treated the best. It's treated best in stocks, it's treated best in precious metals, and there are some other currencies which are more attractive than the US dollars for the investors. So we've covered a lot of ground today, like what is CPI, how inflation and deflation affect the economy, and why the value of the dollar can fluctuate when the Federal Reserve adjusts the interest rates. So the Fed aims for what is often called Goldilocks zones of inflation, which is just around 2%, give or take, because it's considered to be the sweet spot for the economy. At around 2%, prices are rising just enough to encourage people and spend and invest, which keeps the economy healthy and growing. It is not so high that it creates instability, and it's not so low that we risk slipping into deflation, where the economy can slow way too much. So when inflation is in this Goldilocks zone, it helps maintain a balance, keeping the economy moving forward steadily without overheating or stalling. This is why Fed works so hard to manage interest rates and other economic policies to keep inflation rate right around 2% mark. If inflation gets too high, the Fed may raise rates to cool things down. If it gets too low, or if there is deflation, the Fed might lower the rates to give economy a boost. So I hope I'm able to address what inflation is, what deflation is, and how Fed uses interest rates to fight it and keep that interest or inflation rate right around that Goldilocks zone of 2%. So I think that's about it about the topic, guys. So if you guys are watching this on any of the social media, please join our Discord server. The link is in the description. There's lots of good information, lots of good trade setups, and lots of educational material that you guys are going to love. So I can't wait to see you guys on our server. Till next time, you guys have a good week.